Welcome back, everyone. Thanks for joining. Today on the Joseph Carlson Show, investors are starting to get a little nervous. We've had 2 red days in a row. And these aren't just your average red days where the market overall is going down. No, these red days are more concentrated into the previous market leaders. The AI darlings like Nvidia. Palantir is down around 20% from just a week ago. This is a tech-focused sell-off in AI companies, and it's making the markets twitchy. Barron's notes that these big moves off of relatively little news suggest nervousness creeping in when it comes to the AI trade. And when the leader of the markets get taken out, everything else seems to follow. So we have the markets overall following into the red. Now you may be asking, if only there was some sign to note that the markets were getting a little ahead of themselves. Some sign to note that investors were getting greedy. If only there was some way to determine that we were getting close to a sell-off. Well, okay, there may have been some signs. We have people like Chamath Palihapitiya returning to the SPAC game that was a spectacular fail at the peak of 2021. We have Dan Ives saying how the AI trade will go on for years and years and years.
It's my view the next 2-3 years, we have a tech bull market, and I think AI revolution, the actual impact over the medium and long term is actually being underestimated.
Analysts have never been more bullish on their commentary ever. And the bears are dead. Have you seen any bears in the market? Any commentary that's really negative over the past year? The bears are in hibernation. They've given up on being bearish in this market. Well, where does that leave us now? When the bears have given up, when everybody's extremely bullish, and the market's giving us some signs that we've reached a top, that might be a good time to look at your portfolio. Right now, if there is a sell-off, we're very early, and it's a good time to adjust your portfolio if you think that the market could go down further. Now, nobody can say for certain if the market's going to sell off. We simply don't know. But it's best to do this type of analysis before we have a sell-off, not after. So I'll be doing this with my portfolio, going over every holding I have, every single stock, both in the passive income portfolio and in the story fund, the secondary portfolio. I have a combined $1.3 million invested, and we'll be looking over all of it. Now, as we go through my entire portfolio, I'll be referencing a presentation I made that goes over every single holding and my performance. As we look at this, the first page goes over my composition and performance, meaning what my portfolio looks like in combination. This is both the passive income portfolio and the story fund combined and weighted together. When we look at this, we see that the very top position is S&P Global with around 11.5%. So that is the biggest one right now. Next, we have Netflix, which is a 10.6%, then Amazon, then Microsoft, Mastercard, Alphabet, Intuit, and so on and so forth. When we get down to the smaller positions, we have ASML at a 3.6, we have Equifax at a 3.3, then we have my newest position, Duolingo, that's at 0.4%. Now, this presentation was just made a couple weeks ago. Since then, I've doubled my position in Duolingo, so it's around 1 to 2% right now. It's still a very small position. Now, if you look at the allocation, you'll notice some common themes with the type of companies that I hold, specifically the strengths of these businesses. All of them exercise some type of monopolistic power. They have dominant moats, they have the market lead. Typically, they're the biggest in their addressable market, growing the fastest. Many of them have immense operating leverage. They have organic growth. Lots of them are capital light, and if they are CapEx heavy, they exercise a lot of operating leverage to make up for it. And most of them have incredible leadership as well. So we have a basket of companies here that I think are really good. They're called compounding machines. They're companies that just grow and grow and grow over time. Even if you invest in these companies at a little bit higher of a valuation, over time it typically makes up for it because of their immense and continual growth. Now, I'll be going over some points of each of these companies, but I just want to take a quick look at the performance of this portfolio so far. The big caveat here is this is as of the beginning of August. Both the passive income portfolio and the story fund are outperforming their given benchmarks. When I look at the type of companies that I'm buying, holding, and watching, this is how I break it down. The ones that I think are currently potential buys and the ones that I'm looking at accumulating more shares are Google, ASML, Amazon, Salesforce, Equifax, and Duolingo. Those are ones that I think are in a buy territory. The ones that I'm holding are basically the rest of my portfolio. And then ones that I have on my watch list are Meta, DoorDash, FICO, MSCI, Shopify, Spotify, and Uber. These are all incredible platform-based companies, Most of them have huge network effects. I think they have wide moats. I believe this watch list will do really well. Now, enough of the overall summaries. Let's go ahead and just dive into some companies. And we'll look specifically at companies in my portfolio, starting off with my most recent investment, Duolingo. Duolingo's in the story fund, my secondary portfolio that's now near all-time highs. Like I said, Duolingo's a company that's a less than 2% weighting in my overall portfolio. Currently, it's down 8.2%, which is $1,300, but this company has some massive price swings. Just yesterday, this company was in the green. Now we're in the red. The day before that, we were in the red. The day before that, we were in the green. So every other day so far, I've moved from the red to the green to the red to the green. And that is because we're having some dramatic price swings. This is what the stock looks like going back 1 month. This is one of the most volatile stock charts I've seen in a 1 month period. If you watch Duolingo's stock price every single day, you're gonna make yourself dizzy. This is a company that's incredibly volatile, and that's why I pay more attention to the fundamentals. When we look at Duolingo, I can boil down my investment summary into just a couple bullet points. This is why I'm bullish on this stock. Duolingo is the undisputed leader in digital language learning with unmatched brand recognition and global scale. They have a gamified, freemium model that drives massive user acquisition at a very low cost, converting efficiently to paid subscribers. User data fuels AI-driven personalization, reinforcing a self-improving loop of engagement and learning outcomes. User retention is near social media levels. Now, this is the important part. Lots of AI companies will advertise that they have language learning tools. Google does it. You have other companies doing it. I'm sure ChatGPT and Gemini are great places to practice learning languages. The problem is the engagement. Keeping people on your service is the problem. Duolingo has mastered that through thousands of A/B tests. They've made it so addicting to use their product. And that addicting factor, that factor that motivates people to return every single day, day after day, is the special ingredient from Duolingo. So no matter how good an alternative product is, no matter what type of language learning product they make, the problem is always engagement. And unless they create a highly gamified freemium model that has years of A/B testing behind it to hyper-optimize the engagement, it's very unlikely that those competitors will be able to keep people coming back every single day. So that's what I see as the most unique part of this company, is the gamified portion of it, where they have rankings, ladders, they have network effects through social contact, they have streaks that you keep, where you have streaks with other people like different friends. All these type of things increase engagement, and other companies simply haven't gotten to that point. Now, another thing that Duolingo does really well is they have incredibly good cost structure. Their attractive cost structure with high gross margins, subscription-based revenue, and mostly organic growth, and immense operating leverage. Duolingo doesn't have to invent AI. They don't have to pay for expensive servers. They don't have to do really anything except for create really addictive courses that help people learn different languages, or learn chess, or learn math, or learn music. If they can do that well, they're going to make a lot of money. Another thing that I highlight is that this has a large addressable market. There's an estimated around 2 billion people trying to currently learn English, and there's many other verticals to grow into. And Duolingo, in a way, is like a license on the English language. Duolingo should profit by taking a portion of everyone wanting to learn English. As people want to learn English, a good portion of them will use Duolingo. A good portion of those people will end up paying for the service. So my thesis is that Duolingo taps me into the market of English. In a way, I'm investing in the English language indirectly. Now, of course, other things that attract me to this company are the highly recurring revenue, with a huge majority of it being subscription. Around 85% of their revenue comes from their paying subscribers. That revenue is growing 47% year over year. That's really fast. That's in the ultra premium category. Then we have growth across the board with daily active users, monthly active users, paid subscribers, paid subscriber penetration percentage. All of these metrics are growing, and the company already has very healthy profit metrics. So this is a bit higher risk bet. The company is more reliant on faster growth. But if it can continue with that growth for any duration of time, I believe it will turn out well. Now, the big problem with Duolingo today is the social media backlash. We'll see if that's temporary or not. Now, next up we get to Netflix, which is the second largest position in my portfolio. This one's also in the story fund, but it's the biggest holding in the story fund. Now it's a $139,000 position, $82,000 in the green. When I look at this current position, there's a couple things that I can outline of why I continue to invest in this company. Netflix is the dominant leader in a very big category. They're the world's largest video streaming service with over 300 million paid subscribers and industry-leading retention rates. Now, what does industry-leading retention rate mean? It means that the amount of subscribers that cancel their subscription every month is really low. It's so low it puts them into those categories of companies like Costco, where people just really like their service. Very few of them cancel. With subscription companies, churn is the big killer. When lots of people are canceling your service every month, you're having to regain people every single month. And that's not a fun cycle to be in. So it's better if you can just offer a great service at a great value that people continue to pay for every month. And Netflix is doing that. I love that business in and of itself. The next thing is the total addressable market. The global scale of content production with the vast and diversified library of high quality content with continual expansion into new content categories. I've highlighted this before, but other streaming services seem to specialize. For example, Apple is specializing in really high quality, gritty, boutique shows. They're not going for any reality TV contests. They're not licensing any old 70s comedies. Nope, Apple's just focusing on one specific category of content that aligns well with their overall brand. Netflix has comedy specials, they have sitcoms, they have old comedies, they license shows, they have all sorts of movies, they have kids shows, they have everything that you can imagine on a single service. So that makes it so that their total addressable market is much wider than most streaming services. The next thing with Netflix, which I believe is misunderstood by a lot of people, is that this company has an incredible cost structure. It's much better than what people have given it credit for, and this is something that I've been highlighting for years. They have a proven track record of being able to grow the top line faster than their spend on content, creating immense operating leverage. The analysts missed this 3 years ago. That's why the stock was so underpriced. We've heard management speak about the company. They said that they can roughly double the market cap over the next 5 years, and I believe that that's the case. The large total addressable market with over 750 internet broadband enabled households, excluding China and Russia. So right now they're at 300, maybe 315 million. We have 750 million total. They're not even halfway through their TAM. We also have the long-term focused leadership, the co-CEOs that each take different focuses. Ted Sarandos is one of the CEOs. He's primarily responsible for content, marketing, publicity, and Greg Peters, who oversees product, technology, operations, and finance. Both of these CEOs are highly competent and long-term focused. This summarized is the reason that I hold this company, and I think it will continue to do well. The only thing that makes me slightly nervous about Netflix is the valuation. It's gone from a lower valuation to the more premium category, which just means that Netflix needs to continue to perform. If the company has a slow quarter, if they give bad guidance, the valuation will come down a bit. And that's fine, but it's something to keep notice of. So I'm not trimming my Netflix position. I continue to hold this one, and I believe it will still be a winner over the next 5 to 6 years. Next, we get into Amazon, another story fund position. It's moving up very close to the first position in the story fund. Now a $135,000 position, $42,000 in the green. There's only 4 bullet points that I've outlined with Amazon. Amazon offers significant optionality by operating across high-growth sectors: cloud computing, AI models, robotics, streaming video, advertising, and retail, giving it multiple paths to compound value and capitalize on emerging technologies. A lot of investors won't include optionality in their investment thesis, but I do, and I think that optionality is important. Having a company that has a lot of options of where they can grow and put capital into, I think is a really great thing. And Amazon, I believe, has this more than any other company on planet Earth. Now, second, we have a massive labor force. 1.5 million employees. Amazon has a unique opportunity to drive efficiency and margin expansion through robotics, automation, and AI-driven work optimization. Amazon already has 1 million robots working in their warehouses, and they're going to have a lot more. This company will be predominantly a robotics company, with employees being there to help oversee and fill in the gaps. Optimization equals higher margins, and Amazon has a big revenue base, so if you move the margins up just a little, you get enormous amounts of profits as a result. We have the revenue mix continually improving, with a higher percentage of revenue being made up of high margin services every quarter, which literally means that Amazon's becoming a higher quality business over time. Amazon remains focused on long-term growth over short-term profits, leaving significant untapped operating leverage that analysts often underestimate. This is one of the companies where analysts are most likely to get wrong, because operating leverage is one of the most difficult things to do correct analysis on, and Amazon has a lot of it. overall, I see Amazon having a very bright future. Now, moving on, we get to S&P Global. This is my largest position. It's in the finance category of my passive income portfolio. S&P Global is a $123,000 position, $41,000 of that being gains. This is another one that has a few but simple points of why I invest in it. S&P Global has the dominant market position with high barriers of entry in credit ratings, indices, and intelligence platforms that ensure sustained pricing power. Now, what is the intelligence platforms? That is basically the layers of data that they have. S&P Global has an enormous amount of market data, so much so that the government relies on S&P Global for market data. So they're kind of like a Bloomberg in a sense. They're like a fact set. They have all of this market data and intelligence that they provide to all different people. They do it through API, and they typically do it through subscription or subscription-like contract agreements. They're also a subscription-based company. If you're looking at S&P Global, you probably don't think, at least the first thing that comes to mind, isn't that this is a subscription company. It doesn't look like one. And most of the time when we think of subscription companies, we think of Netflix and Spotify. But S&P Global is every bit as of a subscription company as those companies. 84% or more of their revenue comes from subscription or recurring revenue, supporting predictable free cash flow. They have strong free cash flow return policy. They distribute 85% of the free cash flow via dividends and buybacks. I view S&P Global as a very stable, steady company that's reliable for consistent compounding in the future. It's not going to be the highest returning company, but I believe it will have a stable market-beating return, and that's why it's my biggest position. And the next one we're looking at here, which is Microsoft, is another one that's in a very strong position. This is an $80,000 position with $40,000 of that being gains. If we look back again at the story fund, we have more Microsoft in this portfolio as well. $25,000 position with $13,000 of that being gains. Now, why do I continue to invest in Microsoft despite the high valuation, despite the fact that the company has already done so well? Well, the leadership of Microsoft gave a new direction for the company overall. They are transitioning from the typical historical definition of a software company to an AI engine. Microsoft is now being viewed as a toolbox for AI for the rest of the world to use and build upon. Microsoft maintains a near monopoly in office productivity tools, Microsoft 365, with deep integration across enterprises globally, creating high switching costs and consistent subscription revenue. This is one company that has business with almost everyone, and it's a company that no one really wants to move from. Everybody's reliant on Microsoft's tools. Under Satya Nadella's leadership, Microsoft has done one of the most spectacular jobs of leveraging their existing near monopoly to push into other categories. And I see him doing that again. Now we have Azure, which is the second largest cloud platform behind AWS, but it's growing much faster due to migration workload advantage and driving high margin recurring revenue, with strong synergies across Microsoft's ecosystem. The simple reason that Azure is growing so fast, faster than Google Cloud and faster than Amazon Web Services, is the migrations. Again, they have this near monopoly in office productivity tools, and they're using that to leverage everything into the cloud. So they have a bit of an unfair advantage. The growth rate will persist for a little bit with Azure, but I expect it to slow down in the future as those migrations work their way through. Then we have finally Microsoft embedding AI into all of its products, Windows, Office, GitHub, Azure, benefiting from strategic partnerships with OpenAI, and they have a first mover advantage into enterprise AI tools. I do analysis on a lot of companies, and even though Microsoft trades in the low 30s PE ratio, I honestly believe it should be higher. I just have such an optimistic view about this company. Try to think of a company that's better positioned than Microsoft. In my opinion, it's just one of the most deeply entrenched, defensive, monopolistic companies in existence. Now, moving on, we get to Mastercard. This is another one that's been around for a couple of years now, and Mastercard has been one of the most hassle-free, stress-free, mentally easy investments that I've ever made. It's just a money-earning machine that I basically do no upkeep on. I did my initial research on Mastercard, again, a few years ago, and decided to make a significant investment into this company, and so far it's been very profitable. It's a $113,000 position, $41,000 of that being gains. When I look at Mastercard, the investment thesis is so simple. A couple bullet points really outlines why this company is so great. They earn a cut on every transaction that flows through its network. benefiting from global secular trends in digital payment and cash-to-card conversions. Mastercard is actively building infrastructure to enable stablecoin transactions on their network. They position themselves as a neutral settlement layer between fiat and blockchain-based currencies. So they are heavily involved in stablecoin and new forms of payments, trying to more deeply entrench themselves. They're well positioned to capitalize on emerging market penetration, cross-border travel recovery, and B2B real-time payment innovations. They are everywhere, going into every category. Again, the game with Mastercard has become more deeply embedded. With minimal incremental cost per transaction, revenue growth flows efficiently to the bottom line, supporting strong margins and consistent earnings per share expansion. It's an incredible company, an incredible business model. I have not seen any real near-term threat to cause me concern for it, and the valuation's reasonable. A low 30s PE ratio for a company of this quality, a 3% free cash flow yield, that looks good to me. I'm not concerned about this stock, even if we go into a big sell-off or a market scare. Next up, we get into Alphabet. Now, I call it Google, but the official name's Alphabet because they do so much more than just Google. But this is a company that I become increasingly bullish on as we've seen more and more data over the last 6 months showing that they're not being as disrupted as people thought. Now, this one has a far more intense and, in fact, I would say complicated investing thesis than most companies. That's why I believe that this is more of a battleground stock, but I'm firmly on the side of a Google bull. I think the company's going to do really well, and my portfolio has represented that sentiment. In the passive income portfolio, I have Google as a $65,000 position, $7,000 in the green. In the story fund, I have Google as a $43,000 position, $19,700 in the green. Now, Google is a vast company with lots of properties, but I believe we can boil the investment thesis down to a couple points. The first point is that Google has built full stack vertically integrated AI with strong research teams. They have some of the smartest people working at this company. They have leading AI models. Gemini frequently benchmarks as the best model in the world. They have powerful purpose-built compute. You have Google Cloud powering all of this, and you have a massive platform of distribution. Google has Android. They have Chrome. They have YouTube. They have Gmail. They have all the Google Work stuff. It's actually incredible when you look at the distribution. It's rare when a company has all of this. For example, some companies have a lot of distribution, but they don't have the compute. Some companies have the model, but they don't have the distribution. Some companies have the model, but they don't have the compute. A lot of companies are missing some of the puzzle pieces, but Google has it all. That's what makes them truly full stack. When we look at the concerns revolving Google and the reason that the stock price trades at a depressed valuation, there's a couple of them. One of them that's central to the concern of Google is the search business. But the search business has been resilient, growing double-digit in the face of AI competitors like ChatGPT. Search volume continues to increase alongside revenue. Now, there's been other people that have said maybe this is inorganic growth due to AI scraping, but that's not the case. Google management has said routinely and consistently that they're seeing higher organic engagement in their search. Users are using it more. They're doing more follow-up queries. They're using it in all different forms. They're using it with vision and audio. They're using it with the Google application. They're using it in Google.com. Google's finding more ways to have younger users interact with the application in all different manners. So what we see here is the narrative that ChatGPT was supposed to kill Google, and the data shows that that's just not happening. And as that narrative dies down, Google's price goes up. And that's what we've seen over the past couple of months. Now, another thing that's not mentioned here, but I believe will happen this month, Google was sued by the Department of Justice. They were found guilty of being an illegal monopoly, boxing out competitors, creating an ecosystem that was basically just too good, too difficult to compete with, and they defaulted their search engine by payment on companies like Apple, Brave browser, you have Firefox, all these different browsers that Google paid. And the judge is saying that this is too big of a monopoly, they have too big of market share, so we have to do some type of remedy. One of the proposed remedies is Google being forced to sell off Google Chrome. And that would be the worst case scenario. That's being decided in the month of August. Any time now we could hear word that the judge is either allowing Google to keep Chrome or forcing them to sell it off. Now, I believe it would be a grave injustice for Google to be forced to sell Chrome, an application that they built from the ground up, they developed, they gained billions of users on it because people love it. They've kept it free and safe and updated. I don't think they should be forced to sell it. And I also don't think it makes much sense. Google Chrome is uniquely valuable to Google and their ecosystem. it's hard to argue that it would actually be more valuable to a different company. So I don't believe Google will be forced to sell Chrome, but that's one potential risk. Now, on the upside, if the judge comes out and says Google's not forced to sell Chrome, they're just going to have to pay a fine and maybe share some data, some other remedy that's not as severe, the risk of the company goes down, the valuation should increase slightly. I could see Google going up 10 to 15% if we receive that news. That's what's called a clearing event, meaning that this overhang on the stock, one big unknown, will be cleared away. Now, outside of those two risks, there's more good things going on with Google. Google Cloud is growing rapidly and winning both in major deals and more market share over smaller developers. The Gemini AI model gives Google Cloud a distinct advantage over competitors. So even Azure and AWS don't have as powerful of a model as Google. So they have a really good sales pitch that our cloud comes with Gemini, it's deeply integrated, and it's the best model. That's really hard to beat. Now, other catalysts for this one, we have the stock that's growing fast, it's highly profitable, and it remains at a low PE ratio, below the benchmark of the S&P 500 and comparable stocks. Beyond search, cloud, YouTube subscriptions, and Waymo give long-term upside to the company with many avenues for massive growth. So many of us are focused on search, but we also have a great business in cloud, YouTube, their subscriptions, and Waymo. I've argued for some time that the combination of cloud and YouTube alone would be worth around $2 trillion in 5 years, which would justify today's market cap. So I believe this company is still undervalued given its risks, given the probabilities in the future. Next up, we have Costco. This isn't a company that I've actually looked at that recently. It's been basically no news. There's not much happening. Costco's just been operating and executing business as usual. For those of you who have been watching me for a while, you'll know that Costco's a company that I've owned since the very beginning. It was one of the first stocks in my portfolio. It's in the consumer category. And obviously, if you've been tracking Costco's stock price, you'll know this one's a massive winner. It's an $85,000 position, $51,000 of that being gains. So this has been a massive, massive winner. Now, how did we get here with Costco? So here's my thoughts on Costco and the reasons that I continue to hold this company despite the high share price. Costco converts strong customer loyalty into steady, recurring revenue streams through its high retention membership model. Costco maintains a dominant position in warehouse retail, consistently executing a proven strategy of scale-driven efficiencies. Its limited SKU model, meaning limited amount of things that they sell, and massive purchasing power enable it to deliver unmatched value, consistently undercutting competitors on price and service. Because they buy so much of such few items, they get better deals. And because they get better deals, they can price things lower than competitors. The Kirkland Signature brand continues to expand in both scale and customer influence, giving Costco increased leverage in negotiations and the ability to compete directly with national brands, especially when suppliers raise prices. They make the Kirkland Signature version of it at a much cheaper price, and people love it. And then Costco's international expansion has demonstrated strong early success, suggesting a long runway for global growth in nearly every market it enters. Now, moving on, we get to Intuit, a company that everyone loves to hate, the tax company. I bought this one just a year or so ago, and it's been a great position so far, a $77,000 position, $26,000 in the green. And Intuit's been one that I've been reluctant to sell because it's simply just growing so fast. Intuit's growing their revenue around 15%. And they're doing this while lowering the amount of employee count. So they have enormous profits from this revenue growth. When we look at the strategy behind Intuit and the reason that I'm invested in this company, I can boil it down to these 4 points. The subscription-driven model, which again, we have subscription. That's such a common theme in my portfolio. Over 90% of revenue is highly recurring and subscription-based. They're also embedding AI agents into QuickBooks, TurboTax, Credit Karma to automate tasks and unlock new monetization streams, potentially boosting margins 200 to 300 basis points. These AI tools improve customer retention, create opportunity for premium services. They're also expanding to mid-market in QuickBooks Advanced and Intuit Enterprise. That strategy of a company that already has the low end expanding upwards is a very well-proven strategy. It's the very same reason why I'm concerned about Adobe, is because I believe Canva can expand to mid-market. Well, Intuit's doing the same thing, but in their given markets. Expansion into mid-market with QuickBooks Advanced and Intuit Enterprise could see good success, but that's another big growth path for them. Right now, Intuit's on the more expensive side. The valuation's gone up. It's at a 34 PE ratio. But given the growth rate of this company, I can't sell it right now. Next up, we have Texas Roadhouse. I love this company, one of my favorites. I took some gains out of it recently, but that's not an indictment of Texas Roadhouse. Doesn't mean I love the company less. It just did so well, it grew to such a large position, and I have a couple concerns about the growth rate of the company. But that aside, I still believe that this is a very high quality long-term compounder. When we look at Texas Roadhouse, we can see it here in the restaurant category. It's the only restaurant that I still hold. It's a $45,000 position currently. It was around $75,000 with $41,600 of gains. Texas Roadhouse is a multi-brand restaurant. The one that you know about, of course, is the name brand Texas Roadhouse, but they have Bubba's 33 and Jaggers. Bubba's 33 is more like a bar and grill. Jaggers is a fast food concept, serves you the basic Chick-fil-A type of food. Now, all three of these have had strong performance. All three of them are growing same-store sales. All three of them are hitting record high revenues. Management maintains a strong focus on value proposition to customers, quality of food and service. Texas Roadhouse continually gets high praise from customers. You can see it across social media. It's one of the companies that people just really enjoy. There's also heavy investment into digital kitchens and proprietary guest management systems that it's internally developed. These investments have created more efficient kitchens, improved wait time accuracy, and less stressful workplaces for the employees, supporting both cost control and guest satisfaction. They've seen real returns from this. They're continually expanding up to 25 to 30 new locations per year while growing traffic per location with small price increases. The investment thesis of Texas Roadhouse is fairly straightforward. Now, as we go through my holdings, we only have 5 left, and we get into ones that are still really good. In fact, some of these are smaller, newer positions that I think are even higher quality than some of my older positions. Booking Holdings as one example. Booking Holdings is in the consumer category along with Costco. It is a $77,000 position, $26,000 of that being in the green. When I boil down the investment thesis, we have Booking Holdings as the largest online travel agency with a dominant position in aggregation of demand through European travel. Their vast data set of user reviews and listings create strong network effects and scale advantage that are difficult to replicate. Extremely profitable business model with super high margins and asset-light cost structure. The largest expense is advertising, which is continually getting more efficient with leaning into social media-driven ads. One metric that shows this best is how many shares they're reducing per year. For example, just last year, they reduced their overall share count by 4.8%. Now look at a company that you own and see if it's reducing the share count that much. Most of them are not. And they're not doing this as a troubled, low valuation company. They're just doing this because they're super profitable. They can put a lot of money into share buybacks. So this company makes a lot of money. They're lowering their share count. Every investor in it gets more and more equity in the company without doing anything. They have what's called a Genius loyalty program that now spans multiple verticals. And when you're a traveler, if you travel frequently, loyalty programs are really, really big. Those are something that most travelers look for. This one offers perks like exclusive support for top tier members. Over 30% of active travelers hold high tier status, and they book more than half of all their room nights with higher frequency and direct booking rates. So they're getting a lot of business from their loyalty program members. There's also an aspect of this, if we zoom out a little bit, that travel is a part of human nature. As GDP per capita grows, so does travel. I don't have any plans on selling this company as of yet, and even in the case that we go in a market sell-off and a big panic, I believe that this one would be well suited. They've gone through many panics in the past, and they've done just fine. Now, next up we have Moody's, which is very similar to S&P Global, so you're gonna see some crossover here. Moody's is more focused on their ratings and analytics business. So S&P Global has the credit ratings, which Moody's has as well. Moody's has an analytics business, which is similar to S&P Global's data business, but not quite the same. Moody's is more on risk analytics for a business, less on market data. So they're not actually quite the same when it comes to data. They provide tools and services to help businesses, financial institutions, and governments make informed decisions and risk management and improve performance. S&P Global is a lot more to do with market data. Recently, partnerships with MSCI for private credit and Microsoft for data management and acquisitions like the Numerated and Cape Analytics expand Moody's into high growth areas such as Latin America, private credit, and AI-driven insurance analytics, unlocking new distribution channels and monetization opportunities. So you may not be paying attention here, but Moody's is on the move. Moody's also has recurring revenue accounting for roughly 96% of Moody's Analytics total revenue. So the part of their business that's analytics is almost entirely subscription revenue. And again, you know I love the subscription revenue. Moody's has shown a strong focus on enhancing its solutions for the insurance industry, increasing their total addressable market. So this is a company that may look boring, but it is steady and reliable. It has a wide moat, and it's growing fast into all different categories. I have no plans of selling this one. Right now, Moody's sits in the financial category. It's a $60,000 position, $13,400 in the green. Next up, we have Salesforce. This is one that's come under fire a lot more. Most investors have given up on Salesforce. They've fled the company. They're frustrated by the lack of performance, how it never gets a bid, how most investors are concerned about AI companies eating Salesforce's market. They don't like the management. They don't like the acquisitions. There's lots of things to complain about Salesforce. But I believe the company is being underestimated just slightly. I think that there's more to the story of Salesforce. And in fact, I don't believe that the data shows things are quite as bad as investors say about Salesforce. So right now, Salesforce is by far my worst performing position. It's down 10% overall, $6,200 in the red, and that is largely due to market sentiment on this stock. You can see it reflected in the numbers. Salesforce trades at an 18 PE ratio, a price to sales of 6. Most software/AI companies are trading at a price to sales of 12 or higher. So Salesforce is trading at a super low historical valuation. The free cash flow yield is a 5.3. Even adjusted for stock-based comp, it's a 4. Now, a few points that I can highlight here of why I continue to hold this company. Salesforce is deeply embedded across sales, services, marketing, commerce, Slack, MuleSoft, Tableau, and Data Cloud, creating high switching costs and durable renewal rates. So it's very difficult to move away from Salesforce, which gives them a little bit of time. They're in a post-efficiency era. Operating leverage and disciplined stock-based comp drives margin expansion and robust free cash flow growth that funds buybacks and dividends. Salesforce is actually decreasing their share count by a sizable amount. Agentforce allows for new consumption-based growth paths with more than 4,000 paid Agentforce customers with just 2 quarters after the launch. I realize that sentiment's terrible for this company. Most people don't like it, but right now, I believe that the downside is fairly limited. Salesforce could go down to a 4 price to sales, a 15 PE. It could go down even further, but that's at such a cheap valuation that if we get any positive sentiment at all, you could see a big upside move. So right now, I feel fine holding it. Next, we get to Equifax. This is another company that I think is excellent. I'm trying to actively build up this position. Equifax is in the finance category. It's a $53,000 position, $2,400 in the green. And again, this one is relatively new. Equifax is a high margin, deeply embedded data company with dominant market share and work history verification. So not only do they have a lot of data with your credit ratings, but now they're in this whole market where they can verify your work history. Equifax leverages an extensive data fabric, including 767 million records and 4.6 million contributing companies. Also note that their active records, which is another KPI you can look at, is around 200 million, which is the most by far of any company. Now they have all this data and they use it to deliver proprietary insights such as the twin indicator, combining credit and income and employment data, enhancing credit decisioning. So if you're looking at the credit rating of someone, it may also be good to look at their employment data, see if they have a job, see if you really want to give them a loan. Well, they combine that together with this twin indicator. They also completed cloud infrastructure that enables rapid product development, strong new product introduction, and operational leverage. This foundational technology supports multi-data solutions that competitors cannot easily replicate. So they went through this cloud migration to Google Cloud. Another thing that I'll mention, and I think that this 4th point is probably the most important, Equifax is now reaching record high free cash flow while mortgage inquiries are half of the historical average. Again, mortgage inquiries today are half their historical average, and Equifax is still record free cash flow. Now imagine what happens when eventually mortgage inquiries start to trend back up to their average levels. Well, you can see that as another huge catalyst for this company. This is a company that I'm not concerned about during a market panic, a sell-off, or even a recession, because one thing that I'll note is that Equifax is counter-cyclical. If we go through a big recession and unemployment goes up, they'll make more money in their work history verification as people go on unemployment, because one of their big customers is the government using that product. So this is a company that wins during good times and bad. Now, finally, we get to the last on the list, my final holding, which is one of my favorites, ASML. I hold ASML in the passive income portfolio in the technology category. It's a fairly large position, $64,000, and the performance of it, to be frank, has been underwhelming. It's a slight positive return, $1,800 in the green. But the more I look at the company, the more I remain bullish on it. ASML remains at the forefront of advanced lithography, a critical technology in the manufacturing of advanced chips. No company can match their technology supremacy in this critical part of the supply chain. They are at the lead, and no one else knows how to do it. So when I look at this stock, I just see one that no one else can match, and the technology that they're creating is highly profitable, and I see only more proliferation of it. I see only more ASML machines spreading across the world. So right now, I think it's in a very good position. Their install-based management can be viewed as more of a subscription or highly recurring revenue line. Now, I've beat this point to death, but I love the type of recurring revenue streams. And even though this isn't directly a recurring revenue stream, it's not something that's like signing up for a Netflix subscription. It's very similar because if you install an ASML machine, these are $300 to $400 million machines. They're the most complex machines of anything that humans have ever built. So obviously it's going to need a little upkeep. It's going to need a little management. And ASML actually makes it a requirement that whenever they sell one of these machines, they require you to buy their service agreement. So you're basically signing up for a contract, which is residual income to ASML, just when they sell the machines. Over the past year, this install-based management, which is the subscription type of income, has grown by 33%. So we're seeing good gains in this over time. ASML has also successfully increased the average selling price and gross margins through continuous improvements in throughput, overlay, and imaging performance. So they still have the talent to continually iteratively develop these machines, and they have a whole 10-year plan of how they're going to make them way better in the future. So even though they're already in the lead, they plan on keeping that lead. And then there's strong long-term partnerships with customers, allowing for more scaled and diversified install base of machines. So even if someone else could match their technology, which is far-fetched in and of itself, but even if they could, ASML is the trusted brand. They have a moat not only with their technology, but also with their long-term relationships. In fact, many of ASML's customers are invested in ASML. The fact that this company is a great company, highly profitable, with 10 years of forecasted revenues, trading at 5-year low valuations, makes me believe that now's not a great time to sell. I plan on holding this one for the future, and I'm not too concerned about a slowdown. So there you have my overall portfolio and a bit of the reason why I own each of these companies. And I believe the reason that these portfolios have done well over time is because I hold great companies and I typically don't do too much with them. I might trade around one position here or there as I have specific thoughts on which companies at a good valuation, but other than that, I believe the best approach is to be relatively hands-off, to have a diversified portfolio of highly profitable, high-margin, capital-light compounding machines and hold them for the long term. That's what I've been doing with my portfolio for years. I've had great results so far, and I'm not going to change my plan on the concern of going into a market downturn or a market crash. I'll continue to hold these stocks through any environment. That'll be it for this episode. Hope you enjoyed the overview, and I'll see you in the next one.